Robert.
It happened again. I was in the middle of a sentence.
We're right in the middle of a sentence. And they cut us off. Yes.
They cut us off right away. I got to ask you right off the bat.
Sure.
CPI, and I'll probably ask Tracy this again when she comes on, but CPI last Tuesday was fantastic, right? In general. I mean, just because it was, I mean, I'm being somewhat tongue in cheek when I say,
yeah, if you believe it all, yeah.
People liked it, and yields moved lower. The largest amount that they had since March 17th. You remember what happened on March 17th of 2022?
I do.
11 U.S. banks deposited $30 billion into a failing bank to prevent a major systematic problem in the U.S. banking system. Do you think a 1/10 beat in CPI justifies that move?
No, particularly because I don't even believe necessarily the CPI, the methodology with which they calculate it. But that's not the point. The point is that this is what we have, the CPI, and to that. So like the market, everybody knows, like, I don't know if you saw in that CPI, like there was a negative 35% decrease in, what was it, healthcare. Well, that's crap. I mean, nobody's seeing 35% less in healthcare. But I know that's a very tiny part of the CPI, but it just is indicative of perhaps there's other methodology problems, but it doesn't matter because the Fed cares about it, right?
Yeah, but we need to talk to smarter people than us.
Could we have a smarter person in the waiting room? One of our favorites too. Like we have our group. She's one of our people, and I love it. We have Tracy Shuchart, who is the CEO, founder, chief market strategist at Hill Tower Resources Advisors, LLC. If you haven't heard her before, you are going to be in for a treat. Welcome, Tracy.
Are trading fees holding you back? Enter the new age of trading. Most brokerage firms typically charge 65 cents per options contract. So for active traders who trade hundreds to thousands of contracts per month, these contract fees quickly add up to substantial amounts. But with Tradier Brokerage, we offer unlimited equity and options contract trades for only $10 a month. Available on web, mobile, and desktop. Start trading today at Tradier.com.
Hey guys, nice to be here.
How are you? Everything good?
I'm hanging in there. How are you guys doing?
Is that card over? I'm not watching that card anymore. Is it over?
What are you talking about?
You know, a little intro where your head's above my head.
Okay, he hates the fact that my head's above his in the intro, Tracy, which I think it only makes sense. That has. By the way, are you still near the beach?
I am still near the beach. So
times during the week do you go to the beach? Do you ride a bike there? Do you walk there?
It's across the street, so I just walk.
Yeah, that's a very smart move. Like I told you, Jimmy, Ken Griffin yesterday said that the future is Miami. Now, I'm not in Miami, and I'm not specifically saying the future is Miami, but I think the future of the free West is in Florida. Maybe I'm talking my book a little bit.
He did say, though, that there was a caveat there that was in the next 50 years. So
yeah, I don't listen.
It's a lot of years.
So you're saying I'm going to miss it, is what you're saying. I get it.
I'm flying to Key West tomorrow. We'll be flying right over Miami. Now there's a plane in Chicago that goes straight from Chicago to Key West. It's fantastic.
Beautiful.
So I'll be there tomorrow. Yeah. Tracy, did you hear what we were just talking about the CPI numbers? You know, I kind of think that there's an element of bullshit to it. Oh, by the way, I forgot about the ground rules. If we start asking you questions and you think we're missing the point and our questions are going the wrong way, tell us we're full of shit. Tell us, here's the questions we should be asking. You've been on shows with us before lots of times. You know that you can tell us whatever you want and we can roll with it. But what do you think about those CPI numbers from Tuesday the 14th?
What do I think about CPI numbers in general? Should be the question. Right?
Answer as well, right?
I think it's completely manipulated. And really, the thing that happened there was how they changed the metric for the healthcare insurance, right? And so we had, and the funniest thing is, and we had a negative 34% or whatever point change it was, which is obviously ridiculous. But how they changed it was on how they're making money, not making money off of you necessarily. So the metric, how they changed that whole thing. It was negative 34%. What surprised me the most was that all the economists, like Bloomberg, all the Bloomberg economists that they interview, right, got the whole thing wrong and said, because of this metric change, we're going to see, 0.2% higher than what we did. And it came in completely lower. And so I'm flabbergasted in how people took this change and completely got it wrong.
Here's the other thing that struck me about it, Tracy. With such a drastic drop that is clearly bullshit, because nobody is feeling a 34% drop in their health insurance. Just nobody. I mean, it's laughable. And that's why it wasn't highly reported on, right? Because you can't put out things that are laughable like that so that people question the data. But that only resulted in like a 10th beat on this whole thing. I understand it's not a giant part
of it, right? Yeah.
It's a small part of it, but it was 34%. It resulted in a 10th beat. And if it were real, you would have seen other effects within the other data, because that kind of a drop affects other parts of pricing. Am I wrong?
Of course, absolutely. You're going to notice that. If you had such a drop in healthcare, just say, for example, if your healthcare insurance dropped that much, you would see an increase in consumer spending. You would see an increase because people would have, you wouldn't see these defaults in credit cards. You would have extra cash for other things of that nature. And so, obviously, that was an outlier. And again, I question the whole CPI in general, because it's just not what the consumer is actually feeling.
And also, this was an X food and energy drop we had as well. I mean, X food and energy dropped a 10th. That's in a month where crude oil prices dropped almost 11%. So it just, when you start to add these things up, I understand that, like, for example, the core year over year was at what, 3.2%? Am I right? No, 4%, versus a previous of 4.1, with crude oil having dropped 10.76%. The month over month, 0.2 versus a previous of 0.3. So X food and energy doesn't mean X health insurance. And, you take the energy out and you've still got this number that isn't that great. And the interesting part to me, and I want to get your take on this, is crude oil itself. We had the OPEC report, right, Chase? We had that this past weekend or last weekend, whenever it was. And OPEC did what they usually do. OPEC usually skews their report. This is my opinion. I don't have any empirical data to back this up, but OPEC generally screws their report towards higher prices. And they didn't do it as dramatically as they normally do, but they did say that China is stronger than people think. What are your thoughts on that?
Well, absolutely. And I've been saying this all year, is that even though we've had this property disaster, right, in China right now, which everybody kind of equates with commodities in general, we have not seen them kind of pull back on crude buying, right? And even we had the teapots, which are the non state-owned refineries, ask for additional quotas for the rest of the year, which is
that's huge.
Unheard of. Right, exactly. And so I think that's interesting. What I also think is interesting that we need to point out is that IEA, which is generally, as we know, skews towards the negative, right? Mm-hmm. They came out with their report this week and they revised up their demand for 2023 and 2024.
So what are you saying about China and the teapots? Is that their economy isn't as messed up as we think it is, as evidenced by the fact that oil is still in demand?
Well, yes, I think that their energy sector is still doing extremely well. And I think that their refining margins are still doing extremely well. And there's a lot of demand there still, regardless of the property sector in general.
You mentioned today, you tweeted that Saudi Arabia still extended its production cuts, correct? I have this theory, and again, with here, a disclaimer to my audience. When I have Tracy and Bob on this show with me, I know the least about oil of the three of them. They've forgotten more about oil than I do. I'm more of a technical trader, and I'm fine with trading it and talking about it. But these two, that's mostly what they do. So Tracy, um, I just totally lost my train of thought. Where was I going to go with that? Do you know?
I think that you were going to say, all right, so if Saudi, and this is not confirmed, it is not confirmed
Yes, okay.
that Saudi Arabia is going to extend their cuts. This is what analysts are currently saying. They have not said this. We will not know anything until end of November. But you're probably going to say, well, if they're going to extend their cuts, that means demand is in the toilet, right? No.
Because here was the question is going to be, is that I have this theory that as crude starts rallying, as central banks start to pour money on what I think is coming global recession, I think the Saudis would like nothing more than to tighten the screws a little bit to us in kind of a tip of the cap to when we sold the SPR and kind of screwed them back last year. Thoughts?
Mine, absolutely. They want the market to know they're in charge. And just recently, when we had this latest decline from that spike that we had on geopolitical issues with Israel and Hamas conflict, and then we saw a steep decline, almost 11%. And really, what happened is that was all speculators, right? We had over 200 million barrels in spec length taken out of the market. Now, we didn't see shorts initiating positions. It was all long drainage. Basically, it was almost 40% of the market, of the long market drained. And so I mean, if you're bullish oil, that's actually a good thing, because if people start hopping on this market again,
the longs get up.
and go higher.
I got you.
But at that time, we have seen Saudi Arabia come out and said, this is all a spec market. We had the OPEC MOMAR out, the monthly report, come out, and their feature article was exactly on this and said, this price action is driven solely by the speculative market. It has nothing to do with the actual physical market. And even IEA in their report said this market is tight and we're in a supply deficit right now in 2023.
Can you explain that to people, Tracy? When you talk about a supply deficit, is that versus expected crude oil demand versus current crude oil demand? Explain that to people, for people who don't know what that means.
Yeah, so I mean, long and short of a supply deficit means that we're draining the supplies we have faster than we're building supplies we have. So we end up with a deficit. And so if you look at total global oil inventories, we're at the lows of the lows. We haven't been this low in 2 decades. And so what that means is the world is consuming as much, if not more, than we are currently producing. And so there's your supply deficit.
So here's this: is that pricing in a global recession? Is that what's happening? And the second part of the question is going to be: everyone says, "Oh, well, the United States is pumping as much oil as they did before 2020." Are we going to be able to do that, or are we at the capacity of what we're going to do without new exploration, new wells, shit like that?
Well, that's like a multifaceted question. But what was the first part of that?
You can handle it. Wow, it's late in the day.
No, I got it.
Is that pricing in a global recession? That the fact that prices have gone down?
Yes, that's sort of it. All right, so yes, but we have seen this kind of, everybody's been pricing in a global recession for almost 2 years now, right? And it just hasn't come. Everybody thinks, and this is not just in the oil industry, this is globally. Everybody's waiting for that hard landing, right? Nobody thinks that we're going to have a soft landing. Nobody, except for the banks. But realistically, nobody thinks this is going to happen. So everybody's been pricing in this kind of hard landing in the commodity sector for over 1.5 years now. Now we can move on to the U.S. production categories. Now, what we have to realize with U.S. production, yes, U.S. production is at 13 million barrels per day, so they say. But we have to break that down right now, because what we're finding is we have a lot of tier 1 acreage being taken off the market, is done. We have wells are getting gassier and gassier. And so if you look at the EIA report today, finally, after they announced in August that they finally broke down and pulled out what are NGLs. And you have to realize that they're adding NGLs into total commercial crude inventories, and those are not crude. It's not technically crude. You cannot make anything.
You're saying they're calculating it incorrectly. Okay, this is interesting to me, because I love a good conspiracy. Keep going though. Yeah.
So you have of the report today, they have 5.005, if you want to be exact, million barrels of NGLs, which are natural gas liquids, that they add into commercial crude inventories. And those are not actual crude barrels, to be honest with you. You can only make petrochemicals with this product. This is very light. This is the lightest of light. And what's happening with our shale wells is that they're getting gassier and gassier over time, and we're producing more and more NGLs. And these, in my opinion, can't really be construed as crude oil barrels, but the EIA is now counting them in their attempt to be transparent. They have changed this so that they are now pulling this out of the data, so we know how many NGL barrels that they are counting within the commercial crude oil inventories.
And here's the crap about this. Again, I want to let people know you're seeing this a week after we recorded it. So what Tracy is pointing out is that not only is it the wrong number, because people tout a lot how, U.S. has had a record amount of production, but there's a difference between production and usable production. It's not only NGLs, but the level of crude oil, for example, the hydraulic, the fracked wells, the shale wells, they produce the bulk of their usable crude in the beginning of their life, which makes it very important, as Tracy said, when these high-grade assets are taken offline and when there's not new exploration, new CapEx, you can't replace it. One study from Science Direct said that it takes 5.5 years from the time that they begin to explore an area to the time where there's actually barrels being produced. So if you were to go off of that study, the crude that we're seeing today, the exploration started in about 2019 to see this crude. Now, fracking a little bit quicker, traditional wells maybe a little bit longer, but also the amount of crude that comes out of a shale well comes at the beginning. So when you get more NGLs coming out, that's pointing to the end of the life of that well in terms of the usable crude oil that comes out of it. And this is what a lot of people don't understand. And this is why I think that, and Tracy, tell me what you think of this. My thought is that we're developing a new range. We're not in sort of a dramatic downturn of crude oil prices. And what's going to happen, I think, with the EIA is they're going to start being more transparent. And then the other political side is going to say, oh, they started calculating it different to help the other side, as opposed to actually telling the truth about what's coming out of the ground. So what do you think about both of those statements?
Well, absolutely. And we know this is true. I mean, everybody's complained about EIA numbers probably since, 2016 crash, really, right? Mm-hmm. And they've been kind of murky on, what they're counting. And again, there's been this problem with them counting NGLs as part of production. And so, you can talk about, is it politically motivated because they have pressure from the current administration? Is it,
me? Yes and yes.
I'm just saying these are the questions you have to ask yourself, right? Because we, as we're looking at this industry, we've seen a steep decline in duck wells, which are drilled but uncompleted wells, right? Which is what we count on when you don't have any more rigs out. You can just depend on we've had duck wells down. We have had over 130, 40 rigs taken offline. So eventually, yeah, we can keep producing for now, but we keep producing this gassier stuff that's not as
useful,
exportable, usable,
yeah,
usable, like you said. And this is going to be a huge problem. We're going to run into a huge problem eventually, right?
Other energy,
but
but isn't there other energy technologies that are lying? I almost can't ask this question with a straight face.
While you guys are laughing about
you
that, while
didn't
Jimmy
say that with
gathers
a
his
straight
thoughts.
face.
I tried.
Well, so while Jimmy gathers his thoughts, Exxon CEO Darren Woods, and again, you're seeing this a week after we recorded, so I want to read something that he said last night. ExxonMobil Corp CEO Darren Woods warned that making big oil into villains and trying to restrict supply of fossil fuels will slow the path to net zero emissions and keep millions of people in the developed world in poverty. The solution to climate change have been too focused on reducing supply, said Darren Woods. That's a recipe for human hardship and a poorer world. We talk a lot, Tracy, on our two shows, Jimmy and I, about nefarious versus stupidity. Let's just say this is stupidity. How is something like 2 + 2 = 4 so hard for people to understand?
Well, look at the education industry and look what they're 2 + 2 = 5. 4 is racist. I don't know. Math is racist now, so I can't tell you that nothing makes sense. It's the upside down world right now, to be honest with you. But you have to, you have to realize once we're looking at substantial risk in energy transition, green metals, in a non-NERP world. And I keep saying this. It doesn't work. Solar and wind do not work in a non-NERP world. It just doesn't. Even with government subsidies, it doesn't. Look at Siemens. Look at Ørsted. It's ridiculous. Right? And we've just had Germany said 15% of their solar panels are degrading faster than they anticipated. In fact, there was a study that I published or that I put out in 2021 that nobody paid attention to that highlighted the degradation factor in solar panels. And nobody really thought about that. And all of a sudden, it's a non-NERP world. Subsidies have kind of dried up, but it doesn't totally absorb the problem with financing, right?
So tell people what you mean by non-NERP, Tracy.
So if you have, in the free money world, right, when we had interest rates at 0 and you could borrow for nothing, these projects were very affordable on top of the subsidies that they got from governments. Well, now we're not living in a world where interest rates are 0. These companies count on high financing, high borrowing to make these projects come to fruition. And because interest rates have raised so quickly that even the government subsidies that they receive cannot help these companies become profitable. They're still losing money even with government subsidies because the interest rates are so high. And so again, and we're seeing these projects collapse, and not from small companies. Siemens is huge. Ørsted is huge. We're talking very large companies here, not, run-of-the-mill, small, tiny companies that you've never heard of. So if these big companies are running into issues, I can guarantee you the smaller companies are almost bankrupt.
I was speaking at the New Orleans Investment Conference, and at the end, and I hate a question like this, but they said, what's one dramatic prediction for the next year? And I didn't know this question was coming too. And all your things are saying about oil. I said oil to 130 by a full year from now. That's not absurd, is it?
Well, I wouldn't put a time frame on it, but I would definitely say that's not out of the realm of possibility if governments keep pursuing this green energy transition and keep trying to swipe the leg, so to speak, on the fossil fuel.
Yeah.
Then we're gonna have it. We're gonna.
But here's my theory though too, is that we're talking about a bunch of things that are going to line up and going to create scarcity in this intentionally. Shooting, and not just shooting ourselves in the foot, blowing our feet off. But my point is that I think that people are going to get wind of it. Right now, you guys are talking, you guys understand it. So many people do not. All of a sudden, someone's going to wake up and go, shit, oil's going to the moon. And that's going to happen before we start to see the crunch. That's the way markets will tend to trade, right? I got to close this window because of the sirens, but please answer that. Yeah.
Yeah, absolutely. I think energy in general, it's higher for longer, no matter how you want to look at this situation, right? You're having green energy, it's you get prices are rising for solar, prices are rising per gigawatt for wind, projects are getting destroyed. I mean, we're putting ourselves in a very bad position, which at the end of the day puts the central banks in a very bad position, because even though energy is not considered in their metric, right? What you eat, energy and food are not considered in the metric. You have to realize, right? You have to realize that, energy is the largest input cost for most companies. And so if energy prices are rising, your input costs for companies are rising, and that's thus going to be passed on to the consumer. And that's just a fact. And so you have to realize this is also going to pose a really big problem if central banks are trying to, bring this rate back to 2%, which I don't think they'll be able to do personally.
So Tracy, let me ask you, my longer term view, I really like the oil companies. I don't like them in the short term, but I like them in the long term. My favorite is Exxon. I don't like Chevron as much, but from a perspective of your overall economic view, historically, energy works well when there's inflation present. So if we go into a reflationary spiral where growth grows and inflation grows, energy historically is the top performer. We go into stagflation, energy historically is the top performer. Now we know that earlier in the year, energy was one of the better performers this year when we really had neither one of those scenarios going. Do you think that is sort of a pull forward, or do you think we've kind of come off enough in the energy sector where like a renewed bout of inflation is necessarily going to play out the way it has historically for the energy sector?
No, I think it will play out, because I think we're in for persistent higher prices regardless. I mean, we're talking, 11% pullback. Everybody's like, oh my God, the market's crashing. It's $70. You have to look at historical prices. $70 is much higher than it has been historically, right? We've had spikes in the market, of course, but we're talking about, sustainability. I mean, we've sustained $70 plus oil prices for almost 2 years now. That's unheard of, right?
Yeah. And that's also, you guys always remember, like you remember a few years back, it wasn't that long ago, where we were trying to get crude oil, at least we wished crude oil would stay above $40 so that shale could make money, right? As opposed to, because that was sort of the market said that was their break even level. And we're near double that. And this is just like, and this is just like the inflationary thing, Jimmy, where people think that, we got a 0.2 inflation, a 0.3 inflation, that means prices are going down. It's like, I've been gaining 10 pounds a month, but this month I only gained 3 pounds. You're not losing weight.
Exactly. That's what people don't understand, is that inflation is still increasing regardless. Even at 2%, you're still increasing. It's not like you're, and that's why I think there's a lot of misunderstanding in the markets. And you have a lot of people saying, but my food prices still keep going. My energy, well, yeah.
Care costs are down 35%, so I'm fine with that, right?
As long as your health care goes down 35% a month, that'll be fine.
Yeah, Tracy, right. You mentioned interest rates.
I wouldn't hold your breath for that.
You mentioned interest rates a couple of minutes ago, and this is, on the 14th we had that CPI number, and rates, boom, absolutely got clobbered. Do you think that we are going into that inflation is actually moderating, that now the risk is to a recession, and that the Fed's really going to cut? And what will that do to long end rates, in your opinion?
This is, I'm caught between Powell saying, higher for longer, right? And he has not backed off of that because he wants to be Volcker, right? So this is what he's saying, even though the market is saying, well, we don't believe you. Right. So I think that we're in a real pickle right now, because I think heading into an election year, this is going to be extremely difficult. And I think that the Fed, Powell, is going to get a lot of pressure from the Biden administration to do something, because they definitely cannot have a recession going into an election year. That would look terrible for the party.
Yeah, with a recession, I think,
right. And that's why we've been seeing a lot of monetary policy butting up with fiscal policy. And we've seen Yellen doing what she's doing, right? That is trying to counteract any effect that the Fed has on trying to raise rates and squash inflation and slow down the economy. They're exactly doing the opposite. And so I think that we're, I think if you're anticipating a recession, it's going to take a lot longer than you think it is. Like, it's probably not going to happen next year, right? It'll probably happen the year after. Yeah.
Hey, this question is for both of you guys. So again, we're recording on the 15th. You guys are watching this on the 22nd. I still have to look at calendars to see what 15 plus 7 is. And I would say that at this point, it's 3:36 Eastern time, and the follow-up rally is underwhelming at best. So do you guys think that there's any sort of legs to what happened yesterday, or do you think this was like a readjustment and we're just kind of go sideways? Or do you think we're on our way to new highs? I'm looking at a daily S&P chart, and we did break a trend line, but it really doesn't get me much further. And again, I'm saying this a week ahead of time, so you guys can check me on this. It really doesn't get me much further than about 44.98 on the S. This is the ES futures. So for those of you guys who are looking at SPY, that's the opening price from September 15th. Okay. So do you guys think this thing's going to have legs? Do you think it's got to pull back before it could sort of gather its legs? Either one.
I'll do it. Technically speaking, right, we just broke over the downtrend, right? Everybody sees that on, if you look at the daily chart, right? So I wouldn't be surprised if we went and retested the breakout area.
Mm-hmm.
I mean, it just doesn't seem like there's enough. It feels like if you were short, you already got squeezed out yesterday, right?
Yeah.
You heard Burry, exited his short position in both NQ
and he shorted the semiconductor sector. Did you see that? He shorted the semiconductor ETF.
Yeah, he shorted NASDAQ and S&P 500. And so, it seems to me right now that, markets, I wouldn't be surprised. Let me put it this way. I wouldn't be surprised if markets took a pause and we retested the breakout. And that's really where you kind of want to make a trading decision, right? Do you think that we retest the breakout and you want to move higher, or do you think the market completely collapses and this was a fake breakout? So I think that's where you're going to have to kind of make.
What do you think, James?
It's too early for me right now. I want to see a weekly settlement above 44.50, let's call it. And we've put some distance now between, we're probably at about 45.15 right now, right? Is what I don't have it in front of me. But I want to see a weekly settlement. Okay, now I want to see a weekly settlement above 45.50, which looks relatively likely. Again, it's Wednesday. And then I want to see a little bit of strength above that. And then I think we could be in line for testing the highs. To adjust the Michael Burry thing, and I think it's definitely news when Michael Burry puts a short on, because we've all seen the movie, we've all read the book, and he's very, very, data driven, and he's very, very precise about what he does. Everyone said like, oh, he put a $1.6 billion short position on. That was bullshit, by the way. That was the notional value.
That's notional. I was going to say that's notional value.
Exactly. Yeah. If I want to act like I'm a big shot trader, I'll talk about the notional value of what I traded that day. But you guys know that I had very little risk exposure in my day trade, despite the fact that I had $1 million worth of stocks on. Yeah, it was a silly thing, but I think this could be some big. I think that we've been waiting for the Fed to end the tightening cycle officially, and I think that we can agree that that's probably the case now. I do think in quarters to come that long end rates will rally because of profligate spending and issuance, as Tracy kind of you alluded to a little bit before, the fact that Yellen is kind of working counterproductive to what Jay Powell wants to spend, the Treasury spending a shit ton when they're trying to get inflation under control. But I think that the burden of so many bonds being sold will drive up long end rates. I have a steepener around right now, and I'm very, very comfortable with that trade. But I think in the meantime, the stocks could do okay and perhaps test the highs. Does that make sense?
Absolutely.
I'm gonna.
What do you think, Robert?
Well, I want to put something.
Our show
up.
flows so good, doesn't it? Right, Bobby, you go.
Well, I want to put a couple things up, and these are from Mike Singleton at Invictus Research. I emailed him this morning and asked him for permission to put these things up. So I didn't answer you because, as usual, we're so skilled and talented that I was completely ready to share my screen, and I'm talking this whole time while I figure out how to do it again. And I don't think you guys can even tell that I'm stalling the way that I am. But if you look at this first screen here, you guys tell me when you can see it.
I don't have any confidence we will be able to see it. That's the way this show's going. I've forgotten 3 of my questions so far.
Yeah, I think that in the background, they have to allow my sharing. So I'm trying to share it, but I want to show you this stuff. And it's part of the reason I don't want to say that we're not done hiking. We're certainly done for now. Okay. Let's see, where is this one?
Well, if you look at the CME Fed Watch tool, they're pricing in cuts already in June now. So
yeah, that's crazy. I'm sorry.
Well, he's getting it up, Tracy. To you, here's why I disagree with Bobby. And while he's working with technology, he won't be able to defend himself. So I'll take this opportunity. Is that every month that goes on, we're hiking further as people have to roll out of the duration loans they put on when they had the 5-year opportunity to put them on before the hiking cycle even began. This is a very interesting hiking cycle in that before it's never been that way, where there was 5 years of a 10-year yielding an average 1.96%. So mortgages, every idiot had the chance, except for the federal government, had a chance to roll into duration loans. So this is an interesting hiking cycle, and many people were insulated from the effects. And as each quarter moves on, more people have to roll loans into these higher rates. So I think rates, the net rate, the real rate that people are paying is going to be going up for years. Does that make sense, Tracy?
No, but that does make sense to me. I mean, there's a lot of duration that rolls off and starting in 2024, 25, that was basically insulated because it didn't roll off in, the last, 2021 to 2023. And so they've kind of been biding their time, and now it's, rolling off, and we're going to hit a lot of duration roll, so to speak, within the next few quarters for sure.
Think about my steep. What do you think? Oh, Bobby, you go if you're ready.
Yeah, here's the problem to me with all this. When people start pricing in cuts, that means something broke, right? It has to mean that, because if we have, let's say we have 4% unemployment, okay? And let's say we have 3% GDP, and we have a 5 or a 5.5 Fed funds rate. So what? Why cut? Like, what is the driving factor for cutting? Stocks are going up with that particular situation that I just described right now. So why would they cut? There would have to be a reason. Literally, if Biden goes into the election with no recession, with a soft landing, with a strong GDP, with falling inflation, why cut? He literally can go there and say, not only did we normalize rates, but everything's still growing and wages are still rising. Now, whether the public believes him or not, I don't know, but certainly cutting rates isn't going to help the inflation picture and the people who think their prices are still high. I think I can put this up now. Go ahead, Tracy.
Raising rates is actually inflationary.
Yeah.
Because if you look at it, I can argue that raising rates is inflationary because what's happening is that it's raising inflation for energy and food and whatnot. And again, I know the Fed doesn't count that in their metric But again, I'll go back to my original argument where I say energy is the major input cost for every company. So at the end of the day, raising rates is actually inflationary.
Well, here, these next two slides that I'll put up will show you what I'm talking about. So this is a 3-month annualized annualized picture of inflation. And why 3-month? Obviously, it smooths out up and down, right? It smooths out the volatility of the figures. So 3-month annualized inflation for people watching this means 3 months annualized over a year. So it's a good picture of what inflation would look like based on the 3-month average. And right now, the 3-month annualized picture is trending higher in core, and it's pretty stable in headline inflation. See if I can put this other one up. Tell me if you guys see the new one. Whoop, not that one. What the hell did I just do? There we go. How about this one? Can you see durables continue to drive inflation?
See it. Oh, no,
I
see the same one you just put on.
Wait. Nope, that's not it. Let's see. What am I doing wrong here? This is just, it's great how good we are at this show.
How tight a ship we run. Tracy, I want to get back to the trade I have on the exposure. So $1.2 trillion of debt service, of debt is going to be in 2024 from the federal government. It'll be bigger than the defense budget by about $300 billion. Do you think my thesis is that long end rates, particularly after 2 shitty auctions in a row in the 30-year, that long end rates will go higher simply from the weight of the government selling bonds?
I think that almost it would have to, but again, keep an eye on those. I would say keep an eye on those auctions and see how they pan out. But I do like the trade, and I think markets want to see that, to be honest.
Okay,
I think the equity markets would be very happy with that, with the steeper, right?
We should have a new chart available to show now. So here's what I wanted to talk about.
All right.
Basically, as we get this chart up, okay, inflation is falling because of durable goods, right? So we're talking about washing machines, we're talking about dishwashers, we're talking about cars, we're talking about big screen TVs, etc.
And stuff.
Yeah, stuff. The headline durables is down about 2.1% year over year, but the 3-month annualized is pointing to down 5.4% year on year, right? That's pretty disinflationary, right? Deflationary even. But services, okay, 5.5% annualized at 5.2%. Services is 60% of the CPI figure. It's 2/3 of consumer spending. Okay. Now this is X energy. If energy turns around, okay, or even stabilizes, and healthcare doesn't drop another 34%, right, which is of course correct. And again, this is from Invictus Research. Mike Singleton does this research. I asked him for his permission to show these. These are compelling to me. So when we say that I think we can all agree that the Fed is done, I think they're done. But this is also, I think, the reason this kind of data and this kind of deep dive that I'm not able to do, which is why I rely on Invictus to do it, is the reason why you're still hearing some of the Fed governors go, we can't declare victory yet. Because services inflation, which is massive, is still really high, and wages are still climbing. So if Tracy's right, I mean, obviously durable goods, it's home stuff, right? So people can't buy new homes. They can't improve on their homes because if they try to get a new equity mortgage, their home price is a little bit down, home equity loan, their home price is a little bit lower and the rate's too high, so they don't get it. So they don't buy washing machines. They don't buy construction materials. That's the part the Fed's affecting, right? But they're not affecting services, and they don't have the ability to either. So if any of you have any comments, call me stupid, whatever.
Then I'll go.
Go ahead, Trace.
What? No, I think it's really interesting. You have to look at, if you can't spend money on one thing, you're going to spend money on another. If
that's been the case,
yeah. Right? I'm not going to sell my house that I bought at 3.2% mortgage interest rate and jump into one for 7-8%. I'm not going to, again, like you said, open up a new home equity line because that's my rates that were out of control. I'm probably not going to, if you look at, durable goods, inflation may be going down, but overall prices are still higher for those products because energy inputs are still higher. So maybe I don't do that. So what am I going to spend money on? Well, services. Right. So yep. I'm going to go, maybe I go on vacation or maybe I can, with whatever money I have left at the end of the month, if you do.
And now, Jimmy, comes the political part. Good.
But I was going to say something that just kind of is an amalgam of some of the things you had said before. I don't believe that our rate hikes, the rapid rate cycle that we've had over the last 2.5 years, has done much toward inflation. I think the inflation that you saw in those durable goods item was much more product of the supply chain healing. And I'll add, as to bolster my argument, one, what Tracy says about energy inputs going up because of the rate hikes. I'll say two, it allows people to earn 5% on their money and their savings, which is making a lot of retirees feel better. And three, isn't really sucking as much money out of the economy as they'd hoped because of the fact that everyone had rolled into duration. So I think if they continue down this path of raising rates, all they can possibly do is completely stop any business capex, any new businesses, any even buybacks, things where it used to be you borrow money cheaply and buy back your stock. But they're going to be stopping just to a grind all the things that would be good for the economy in a year. So all they're doing is digging us a hole. Do you guys have any comments on that? Is that a decent thesis or no?
I do. The data backs you up, Jimmy, because durable goods as unit sales are not dropping. The prices are dropping, but durable goods is doing what it always does. Just kind of like this. 1 month it's up, the next month it's down.
Prices are dropping relative to what?
Yeah.
Sorry.
Relative to higher prices in the past, yes. But the unit, to Jimmy's point, the unit sales are not dropping. Not dramatically anyway.
Yeah, Tracy?
So yeah, absolutely. I agree. I agree with that. Said, I think we're gonna. This is not an exciting question because we're all in agreement. But I think again, we're gonna have a problem. I think we haven't even begun to see what rate hikes are really doing, given the velocity of the rate hikes. I mean, it's faster than we've ever hiked in history, right? And so I don't even think the economy has even digested this yet, because as we all know, it takes time.
The reason I brought it up is because when you said it was inflationary, I thought you were going to go with the fact that I can put all my non-invested money in a 6-month bill and at one point in time getting 6%, and so can every other person who's got money on the sidelines. But you didn't mention that, but I assume that's part of your thesis as well, correct?
For me?
Yeah.
Or for
you're the guest. We want to hear what you. I know what Bobby thinks.
Obviously, and that's been the trade, right? Everybody, that's why we had markets waffling for so long. Kind of because put your money in, put it in a money market account. Go to the U.S. Treasury. Go to buy. Park your money there. Don't worry about what the market's doing. Who cares? And you're making a higher percentage rate, right? So of course that factors into everything.
So Tracy, how does this stuff all play out? Like, what do you see in the next 6 months, 1 year? Take any asset class or take just a broader macro view. How does this all work out? Because I'm very pessimistic.
Well, I'm very worried about the energy industry. Obviously, that's one of my main focuses. I'm very worried that energy prices are going to continuously be higher, even with renewables. Because again, I'm telling you, renewables do not work in a non-urban industry. And so you have, when you had Ørsted going to New York and saying, we're going to have to raise your per watt prices by 63%, or we can't do this project, and you're going to thus have to charge your customers an extra 63%. the board in New York was flabbergasted. I mean, literally, they couldn't believe it. They were like, "No, forget it. We're not doing this project. This is ridiculous," right? And so, at least I would say on a positive note, people are kind of beginning to see this, or governments are maybe kind of beginning to see this. We'll see how that pans out. But the long and short is it's higher for longer for energy prices. Green energy is not going to save us. That's actually going to cost more in the long run than it is for fossil fuels. And I think that's going to be a big drag on the economy. I don't think the Fed can raise rates enough to dampen demand for energy prices because it's relatively inelastic, because everybody wants to heat their homes in the winter, cool the. Everybody's got to drive to work. Everybody's got to, EU might be a bit different. They're not as big of a consumer, but for the United States in general, we have to go. Your kids got to go to school. They got to get on the bus. You got to drive to work. You have to, the economy has to function. And even at COVID levels, our consumption, our daily consumption in the United States barely dropped 3 million barrels a day. And that was when the entire economy shut down. And so, we have to look at things that, yeah, exactly. And so we have to look at things like, this is just going to be a major input cost, and we have to be concentrating on this. What happens over the next 6 months? I don't know. I think the Fed's probably on a pause right now. I don't see cuts just because Powell has been so adamant, higher for longer. I don't see a reason to right now to really cut rates, even though the market, is excited that, we had this CPI print that was lower and the market exploded higher, thinking, oh my God, we're going to cut rates in June. So, I think the market is thinking one thing. I think the Fed's thinking another thing. And so I think for me, 6 months out is really not long enough for me to make a big projection. I can say I don't think they're going to cut rates within the next 6 months at all.
So is that when somebody like me says something like energy outperforms in inflationary environments, is that sort of like saying every time there's rain, somehow clouds develop?
But yeah, well, absolutely. I mean, we've seen this over and over again. Look at the 1970s, for example. And, and I still think we're kind of on that path. I think we're on the path where the Fed thinks, inflation is kind of controlled, and then all of a sudden it explodes again for reasons other than what they think. And again, I'm going to point to the energy sector in this. And so I think right now, energy pulls back $10 and everybody's like, I'm out of energy stocks. So you have to realize, if you're looking at these companies, they're making money hand over fist right now, comparatively speaking, into the days when they were just drill, baby drill. They were making no money, drowning in debt, right? And this is a totally different environment. And I think investors are just not really looking at this situation right now.
I think that, first of all, I'd say, how dare you both questioning the green revolution that's going to save us all from certain death within the next 5 years. I've been told this by very reliable people. So clearly you two have not read the manual. No, the point I think we're all trying to make is it's stupid, but I do think from a positive standpoint, is if we get a different administration, and again, I'm not very political, I'm very policy driven, but this will be the last question because we got to get you out of here. But if we get a new administration in that is not so tone deaf and not so oblivious to the error of their ways, that could certainly help things, correct? And that'll be it then.
Oh, well, absolutely, it could. Of course it could. But we have to see, how that pans out. And I also think that there's just this Western global push kind of, for this green transition. If you don't believe in this green transition, you're out of the cool kids club, and, you're not getting votes, and you're not getting, whatever. And so whether these people believe it or not, this is what they're running on because they think, this is what you're supposed to run on and this is what you're supposed to say. And regardless of the actual science involved. Just my opinion.
I got to say something. Mark Zuckerberg, Bill Gates, Elon Musk, they weren't in the cool kids clubs when they were younger.
And they want to be so cool.
We should pay attention to that.
And now they're vindictive and they
pay attention to that. Because we're not in the cool kids club.
I think we just put our finger on the whole movement right there. Vindictive kids who now want to get their say at things. It's just completely absurd. Is that the bell?
That's the bell.
That was the bell.
Right. Sorry. Thank you so much, Tracy. Always fun talking to you. Really awesome. Thank you.
Thanks.
Sorry. Thank you, guys.
Boom. Sneeze is the exclamation point.
Cheers, guys.